just a few minutes early on the YouTube side so that I can do a little bit of commercial on the Bullish Bears. I see questions all the time about people that are looking for the content, right? The education. And on our website, we've got courses, and then we have advanced education, and then we have another level even beyond that, the next level library. And I understand why, if you've never been into the next level library, you might think, well, I don't need that. I could understand it. But once you've been in there, once you see what is in there, then maybe you would perhaps change your mind and think that's what you've been looking for, especially options trading. When I was first hired at the Bullish Bears, they didn't have a next level library. They didn't have this content. And that was my task. But we didn't even have a next level library. Like, we didn't know what it was going to be called. They just knew they really needed some advanced educational content. And I was new to kind of, making videos and doing streams. So I didn't quite know what to put into each of the videos. And so I put everything into the videos. That's been like one of the main complaints that we've been working on since I built all these out, is that the videos were long and way too much information in one video. I get the complaint. I totally do. And we've been working to fix it. But out of all the complaints I could have ever heard, that complaint kind of made me feel good. I didn't hear somebody say, what a waste of my time. I watched that video and I didn't learn anything. Instead, what I constantly hear is, oh my God, there was so much stuff in that video. I had to watch it 5 times. So we've been working on that, making these videos smaller. We've got a whole new group of videos coming out that break them down into smaller parts and pieces. But if you are trying to learn how to trade options and you've got the grasp of what they are, calls and puts, and trying to figure out, well, when do I use them, and what expiration should I use? What strikes do I use? How do I manage it if it starts to go wrong? These are the videos you need. These are the ones that you're missing. So I like to take the time every once in a while to point out, the content on our site. There is a search bar too, and that really helps because it's not easy to find things. If you don't know what to search for, how can you find it, right? But you can run basic searches, names, strikes, things that you may have heard me mention. You can search for those. There's a blog. Our blog has gone on for years. You would be amazed at the content in that blog. And then you can always just go to YouTube and type in the words Bullish Bears, and then whatever it is that you're looking for, say Bullish Bears trend day checklist, and you're going to come up with our content. So just a short little plug, a little commercial. The content you're looking for is on our site. Use the search bar, hunt for what it is. And if you can't find information that you're looking for, tell us. Either you're not looking in the right spot and we can help you find it, or we don't have it and we will go make it. Right? We're always looking for any feedback from you guys. If you want to see videos and we don't have them, if you want content that we don't have, reach out, tell us, give some inspiration by all means. I'm always interested in hearing about new stuff that I could make videos on. Right? I am not an artistic person, so if you guys can inspire me to make more videos on some content, then let's do that. Right? Okay, so commercial over. Let's bring in the Zoom crowd. It's Friday, by the way, guys. So, you know, chin up, get ready for the weekend. Don't forget to set the egg and go to make your peanut butter cookies. All of the material is at room temperature, right? At least I'm going to be making peanut butter cookies. I don't know what you guys are going to do. All right. Good morning. Good morning, all you Zoom people. I see that comment, Jeff, that you don't play options, and I promise you I could show you one trade that you would love to do, and it's a very simple options trade. It doesn't require a lot of background experience in options to do it, and it would just add a few, maybe maybe $400 or $500 every 6 to 8 weeks. And I know that that's not a lot of money, but when you consider that it's like no real technical analysis to do it, it's a real laid back, easy trade for just a couple $100, and it ties up a small amount of buying power to do it. I think you'd like it. It's a good one. All right. Good morning, everybody. Good morning. Good morning. It's Friday. We have the unique situation today where bad may be good and good may be bad. So we're looking at the unemployment numbers today. They just wrap it up into like the unemployment situation. There are all kinds of economic numbers going to be coming through in this jobs report. And this is the absolute crux that the Fed is going to use in March for their decision. They're going to point to this report and say, yeah, but blah, blah, blah. So if these numbers are good numbers, then it's really going to give the Fed the validation that it needs to begin liftoff and to start cutting that balance sheet. So good numbers are going to cause an interest rate hike. The market does not like interest rate hikes. So good numbers are going to be bad for the candles, right? You're very likely going to see good numbers and then red candles, or you're going to see bad numbers that the unemployment situation is starting to get worse, that we're no longer at quote maximum employment, whatever the hell that is. And then those bad numbers will be seen by the market as good because it may imply that the market that the Fed won't do a liftoff. And they've already started backpedaling, and in fact challenged him the other day. And I would like to put it in my oil field terms, but I try to keep it PC. Do you have the cojones to actually do what you need to do and lift rates? And he said, yeah, of course, if we absolutely have to, we're going to raise rates. But they backpedaled so far, they're almost to the point where they're not going to raise rates. Why? Because the market threw a temper tantrum and they're afraid that it's going to sell off. On the other side of that, though, there is the psychology that when they imply they are going to raise rates and then the market starts to price that in and it does sell off, it usually accomplishes what they were trying to accomplish by raising rates. And at that point, they don't need to raise rates because the market already priced in the raised rates without having to have raised rates. Whew, that is a mouthful to try to say, but you get it, right? Like they bluff a raise, the market prices in the raise, so therefore they don't have to do the raise. And that's what Powell is trying to lean on at the moment, that they may not need the raise to raise the rates after all. I looking at the inflation, I say they better do something because it's getting worse. All right, so we're using Econo Day today instead of the normal FX Street, and I have this calendar, by the way. I bought it. Don't buy it; it's not worth it. I thought there was going to be something else in there than it is. Um, This Econo Day website is what Thinkorswim uses to give you your market watch description. So when you come in here and you click employment and you see all of these things, it comes right off the Econo Day website. Thinkorswim didn't write this description down. It doesn't. It just gets it from here, right? So Um, if you want to perhaps become a basement economist and to begin understanding the impact of the individual economic events and how it affects our market, this is a really, really good place to go. And I'm not signed in. You don't have to like buy a subscription to have access to this. And it is a really great website to slowly begin understanding how these economic events uh, are used for all kinds of things, right? Not just on a day-to-day basis, but going forward, how they get the targets in the S&P for the end of the year, right? Which I heard Goldman Sachs say 4,500 in the S&P at the end of the year. A big step back from where they were as we were coming into the year, talking about 52 and 50, 53, 54. So we're way off um, those high numbers. Either way, 8:30, 8:45, 1 o'clock, those were all on the list. And then for next week, right, we're looking at March 7th. When we bring it back in here and look at it just for today, it's 8:30, 10 o'clock, and 1 o'clock. Now, I worked on the drilling rigs for 20 years. That one's not expected to be impactful, but don't shy away from it, right? Be aware of what time it is. We get near that 1 o'clock, just in case, right? Just in case for today, be careful on that one. And I say that because, with everything going on with the whole energy crisis, you don't want to sleep on this one, right? Sorry, I got distracted. Somebody said something about the Zoom not working. You guys in Zoom okay? You got audio, you got video, all good? I don't normally have that kind of Zoom issue. Makes me makes me think it's someone on I think it's user error from the other person. All good. Thanks guys. Just checking. All right. When you go and start working on your CMT certification, if you were looking to be a chartered market technician, you start learning a couple of little tricks and focusing on a different part of the chart. This may feel a little zoomed in, and yet I spend a lot of time on a daily chart with this perspective. I would even be zoomed in more, but I don't like how the candles look when I'm zoomed in this close. Although this is really all that I'm looking at, and it really is all that we need to focus on today. But this just is too much. It's too much in my face, but these are really all that we need at the moment. And what I'd like to point out, because it's really important to grasp this logic right now, is that we're just winding up more and more and more and more energy right here. Right. And what happens in the market's very much like a thing of nature. In nature, you don't contain it. Every time they've ever tried that throughout history, it explodes. Right. When you build a dam to contain water, you have to let water out of it. Right. You got to have a spillway. You got to release that pressure. Nothing in nature can just be bottled up. It's just going to build up more and more and more and more energy until it finally pops out of whatever it is. This is what the market is doing right now. When this finally does break, when the dam breaks, it's going to make one heck of a move. Now, there's no implied direction here. It's not promising to go up. It's not promising to go down. What it is promising is that they're building up a lot of energy. Right now, we're looking at an IX10 pattern that is extended beyond the third day. Right, IX10 inside day. This is the controlling candle, and markets, and it's what they do. They aggregate. They expand a little bit farther, a little higher to the upside, a little lower to the downside, because that's where the liquidity is at. Right. And then, of course, when you add in the move from last night, that was a little bit of a sticker shock. I got to tell you, I was watching TV with the family and I see that post about the nuclear power plant. And, well, yeah, it kind of ruined family night. I was back in the office. The market really got a shake last night. And it does fit what I've been trying to tell everybody. The technical analysis only gets you so far because what we're going to see in the market will be directly connected to Ukraine and the Fed. Right? So it doesn't matter if we're at support, it doesn't matter if we're at resistance, or if you can identify momentum in the trade for swing traders, right? It's all going to hinge on the Ukraine. If they start serious negotiations of peace and Russia starts to back away, you're going to see this market explode to the upside. If they happen to accidentally kill European civilians or American civilians, you're going to see this market go to the downside. If they begin hacking nations like Japan or Russia hits Europe or America, you're going to see this market move to the downside, and it will make Corona look like a pullback. Okay. You could shave off 50% of the current market, and that would be a good starting point. So, be very prepared for this sort of situation. Right now, we're just looking at these sideways candles and preparing for our opportunity for today. Should we break down below outside of that range, 4250, then we will absolutely go to 4100, and there's nothing to catch it, nothing to slow it down, nothing to stop it. That'll be our target to the downside. If things start to look good and we break to the upside, the one spot we really got to focus on, 44.17, to be the top of that highest wicked candle in this IX10 range. There are cog lines, right? We got 44.11, 43.11, 42.11, 41.11. Each one of those cog lines are a place where we expect the market to react. And we'll just bring in, it's going to get a little ugly. We got the weekly expected move. We're done for the week after today, but this is the range of that weekly expected move. We did dip outside the box on Monday, but we came back in. We've been holding inside that box all week. We're going to be looking to close inside the box even yet again this week, just like last week. And, that's kind of the standard. We close inside the box more than 80% of the time, as we expect to, right? The size of the box for next week is much bigger than the size of the box for this week. And I get it. I know there's a lot of junk on my screen right now, so it's hard to see where that box is. But this is the size of the box for next week. And if we put it on this week's box, you can see how much bigger the volatility is. Well, that difference in volatility is a game changer when it comes to the options that we trade and how the algos trade and a lot of different parts of the way that the market moves. We do have a divergence as well, by the way. If you look at the MACD, we got that line moving to the upside, connecting this pivot and this pivot. But in price, we got that line moving to the downside, right? So this is a bullish divergence. So right now you can see the S&P is flirting with that cog line, just lifted off of it and came right back up again. It's going to be in play no matter how many times we cross through it. It's not like a normal pivot point where, we pass through it a couple times and then it loses its validity. Cog lines are completely the opposite. We want to maintain a clear perspective when it comes to the volume and price ratio at these cog lines, which is easiest to see on a 1 minute time frame. The range is very clear, even though we discussed it on the daily time frame. Looking at it on this lower time frame kind of helps cement that perspective. The range is very clear. This volume box is getting smaller and smaller and smaller, right? That's that compression that we were just talking about. We gauge that by using the RSI Laguerre. I've got videos on this and I share this in the Discord, so you'll already know where to get it. I've got like 5 videos on it, including pictures of what the trade triggers look like if you are the sort of individual who trades using indicators. I'm not, but that doesn't mean anything. So we're sitting at a high gamma level, and we've got the RSI magnetized to the downside, which gives us the possibility of a J-hook signal. The J-hook signal comes with an elevated gamma, and of course the J is the blue, right? So you imagine what the picture of a J looks like. Well, there's the bottom of the J hook, but it needs to be a J hook with a high amount of gamma. The pictures and the videos will make more sense than me trying to give a really fast rundown, but that's what we're looking to spot. It's a bullish signal when we get one. And this is how we measure energy. So knowing or seeing that the market has just been sitting there winding up more and more and more and more energy, getting ready to make that break. We are still inside the box, even though the box has gotten a lot smaller, a lot tighter. We're still inside that box. But should we break to the downside, we got a shallow area here. One last hurrah, a little bit of volume support around that 42.25 area, and that's it. Then we're headed back down to this previous low. And there is enough structure down here to be support, but it'll depend on what sent us in that direction and how big the candles are, right? Very large candles, we're likely to bounce off that area. Grinding to the downside, we're very likely to chew through that area. We've got an ADR of 2.4%. And of course, 12 hours are already done. So you could imagine that in the time that we have left, we're down a half of a percent or more, 0.75%. If we were to start challenging the upside, we've got to make it back through this pivot point here around the 61. So that's 43.61. Then the peak right before the nuclear power plant alert, which would have been around 43.75. And then we start getting into yesterday's ranges. That 4,400 has been a real roadblock. No kidding. What a powerful, difficult pivot point that we've managed to get through in Globex, but we haven't managed to make it through in the middle of the day. And it's always important to point out the difference between a Globex push and a non-Globex push, because markets tend to jump over places in Globex, right? And even that one was more of a linear regression or a blow off top signal, right? And this the depth and scope and size of those candles. So 4,400 to the upside is going to be a real difficult level to get through. And even if we do get through it, we will get the cog right above it. It would not surprise me if we just stick the range for the rest of the day. And that's going to basically be our first assumption, is that we're just going to stick the range for the rest of the day. Very likely not see a low deeper than the low created last night around 42.80. So that gives us 42.80 and 43.80, a nice 100-point range. And in the S&P, that's more than enough room, right? We're down 0.75%, so we could run back up and just be flat on the day. I want to stay directly connected with the sectors today, right? We want to continue to hunt for any sort of capital rotation going on out there. The bonds, the dollar, gold, Bitcoin, we're trying to find those havens, right? Looking at the safe haven coming in through gold. When you see gold starting to move, it's the opposite of our market right now, right? So it's like it could be your early warning indicator. Looking at the Nasdaq, we got again a very tight range. Let's go back out to the daily time frame and do exactly what we had done earlier. Just look at the candles, get rid of everything else, don't need it. We're going to get ugly with it and just kind of zoom in. We've still got one candle that's in control of all of these, one ring to rule them all, right? I know I'm a nerd. I don't need to hear it. Price aggregates. It tends to expand a little more each time. But we are winding up. This is IX10 at its finest, just winding up more and more and more and more energy here until it finally makes a move. 13,700 is our line in the sand to the downside. If we should break that, it's going to drop like a stone in water, right? The low of the low, we get down around 13,000, and it will be really bad. We've got a correlated market. The Nasdaq is down just as much as the S&P is, 0.75%. We are well off of those lows because the market did rebound nicely when they realized that that power plant had a lot of protection built into it. It wasn't going to go all Chernobyl on them, and that seemed to calm the market down. We lifted up off those lows well, but we're very likely going to just come back into the range, the same range that we've been dealing with. And I like to kind of think of those in zones, just tighten everything up, right? Make that box a lot smaller. Well, when I do that, we start hitting these institutional pivot points, close, open, another open, the low of the day, the low of the day, and where we are right now. Those are repeated institutional pivot points. And the more that we do that, the more that level becomes a level of importance. That's 13,900. 13.8 seems to have like no respect at all. So we're moving through 13.8 really easy. So when we think about, well, how easy and is there any volume support, we can bring it back over to the volume profile and the TPO. And there is one level of support, a little bit, but not very big and not very much. Uh, we really don't start to see any kind of volume support until around 13.5. So if we start breaking to the downside, there's not a lot there to catch us. It's a very deep, shallow area. We are inside the box, and it is a very, very narrow box. We're talking about value area high, value area low, and point of control, the three pieces of a volume profile. Well, the value area high and low is very, very squeezed. This thing is just primed for a massive move. And we have full energy in a J hook pattern. Oh, we don't have the J hook yet, right? But we can't have a J hook unless we're on the bottom. Here's an old example of a J hook, full gamma, magnetized along the bottom, and we got that J hook. And what did we get? That market move, right? That's the kind of move that we're looking for. There's been books written on this. And like I said, I shared the indicator, made some videos on it. It's all going to be the numbers today. And after the numbers are done, it'll be us watching the market news for anything coming out of Ukraine. You also want to watch for anything about energy, right? Because they're still trying to put a lot together. Russia's now sanctioning, others when it comes to natural gas supply too. So, it's just a crazy mess. So the news is going to be the dominant thesis on anything that the market can do. Just mark out your critical levels. And again, we've got a bullish divergence. See how we're matching this pivot point with this pivot point. When we do that with a line, it's a lower sloping line on price. But when we do that on the Bollinger Band, it's an upward sloping line. Right? So this is a bullish divergence signal. We do have a crossover, but we're still in a primary downtrend because we're still below the zero. Right? When we're on a daily chart and we got the MACD below the zero, then the primary trend is to the downside. If you want to understand more about primary and secondary trends, dig a little bit more into Dow theory, right? It gets into detail on primary, secondary trends. But this is indicating that things are looking better. It'll still be directly connected to the news, though. The recommendation is in a setup like this that we want to start building longs even before the market starts going long, right? It's what they always say. You got to go long when the market's short, and you got to go short when the market's long. It's hard to sustain that, especially in options. Really hard to sustain that. So if you was to go out and start buying calls around 120 to 200 days out, make sure you are thinking about selling calls against it, which means you don't want to go really far out of the money and buy a call. I know that it probably seems like a good idea because those are cheaper and you're thinking, well, yeah, I believe Apple could run, a good 10% back to the upside. I'll just buy a Apple call 10% out of the money. I get it. It's cheaper. It's going to make you feel better, but it's the wrong one to buy because then you can't sell Apple calls in front of it unless you're also selling those Apple calls way out of the money. You're not going to get any of your money back. So then your long call is just degrading, costing you money, and you're not making enough money on the short side to cover that cost. It always comes back to if you're not willing to risk money, you're not going to make money, right? So if we go out to say October and I wanted to buy a call in Apple, I'm going to want to target something near or at the money or even in the money. These are very expensive, right? We're talking about risking $2,000 to buy a call. I don't want to risk $2,000 to just hold a call and watch it slowly decay unless I know that I can in some way start to earn that money back. Well, if you're at the money or even near the money. If you want to sell calls now that you own a call, you would be selling calls at or near the money for a significant value, right? These are six, seven, $800 options. But if I had bought some way out of the money option back in October, then this would be the stuff that I'm trying to sell now, right? And you can see we're not these aren't viable options that we would want to sell. This is crap. We'd never make our money back this way, right? Now you can sell the 170, 160, 150, even if you did buy the 240 or some out of the money option. But now you're going to increase your buying power reduction significantly, right? So we're talking about being able to buy and sell options without increasing our buying power or even getting buying power back. Because if you buy that 165 and spend 2250 to do it, and then you come in the front and you sell the 165, you will regain buying power. You won't have to spend more buying power. Just something to think about. We got to go long while the market's still going down and then be able to sustain that long if it happens to go down even more. We can't be bleeding out thousands of dollars in options without a way to recoup those funds. Before today, we want to see the Nasdaq get back inside of yesterday's range. Right now, we're not in there yet, right? We're still on an inside day breakout to the downside. So the low of yesterday, the RTH low, is right now an institutional pivot point that's over our head and causing us resistance. So we need to get through that just to even get back inside the range. This is a very large range, plenty of room to make money, but it's likely going to be choppy today, right? Uh, we're looking at a market going into the close on a crazy week. And you got to kind of ask how many investors out there right now want to go and start and open new positions and then hold them through the weekend in a week like this? Nah, right? Nah, So adding to that, we had talked about Google and we had talked about Amazon yesterday, and I showed a really great trade setup that we were priming into going into the close yesterday afternoon. The setup yesterday was this deep, big red candle. And the idea was one, you could avoid PDT if you put it on yesterday, put on a call credit spread as we went into the end of the day. Because what was the idea? Well, the idea was after a big, deep, dark, hard move to the downside, that the market jumped out the window on the way down and now has to take the stairs to get back up again. And it would be very unlikely for Amazon or Google, either one, to reclaim that level, right? To run back up by the end of the day today. So if you had put on a call credit spread in the later part of yesterday and used the high of yesterday for your break even to you use it for your strike selection, you would now be coming into the day with a 0 day in play. And considering how much we dropped even more in the overnight, that's not a guaranteed thing. We don't say guaranteed in the trading world, but it's a very high likelihood winning trade. At this point, it's still in play. You would just be opening it today, and you would now have to deal with, a PDT. But depending on your account, that's not going to be a big deal. So you could still target this 30-80, 30-70 range. And hey, I get it. It's way, 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 way out of the money. You're going to be very lopsided on your risk to reward. I'm not saying that this is something you want to go do all the time. This is just an opportunity that arises from time to time. Amazon, Google had the same setup yesterday in Google. Um, we were going to put on an iron, but then the implied volatility shifted and ended up not putting the iron on. We broke a critical level to the downside. It may not even reclaim, but I gave the shout out around 345, 350 yesterday that you would want to go in and put your call credit spreads on in Google going into the close and to target that 2710, 2720 area. That would have been a very amazing trade. I didn't put it on in the close. I was looking for today to put it on. I was going to go ahead and just take the PDT lump, but it would have been good either way. On Google, I was a little concerned, and I still am. Well, I was, but we're below this line now, right? It's not showing up on Thinkorswim. because Thinkorswim doesn't show today yet. Little trick though to make it show today is go to custom. Yeah, I guess we can do it intraday. Just go to intraday, set that thing to 12 hours. So now it's just like looking at a daily chart, except it's not a daily chart. I think I hid. Yeah, we want to show it. We just don't want them to be there in gray. There we go. Now we got it. So it looks just like a daily chart, but it's not a daily chart. So you can see Google did break down below that level, right? And it's back inside the box, but it's very unlikely that Google's going to reclaim yesterday's highest point. So that trade's still in play for today. Just throw a credit spread on around that 2,700 area. And hey, I get it. You're going to be very lopsided on your risk to reward. But I did one of these Wednesday in the SPX, and that was $1,000 in a couple hours. And I barely paid any attention to it because it was unlikely to make that run back up. Yeah. Yeah. Okay. So we're looking at the sectors here in the pre-market. SQQQ is bid up 2.13%. Imagine that. A little bit of volatility. Oil and gas is bid up. The marijuana industry is showing that it's bid up a little bit, but certainly not seeing it in the candles. It's just that little bot right around 923. The trend is clear and consistent. Use a linear regression drawing. Metals and mining has been absolutely nuts. You can see this 5-day chart. We started the week around $40, $49, and we're ending the week very close to $59. That's a significant change in pricing in the week. And look how clear that signal is. I don't expect that's going to end quite yet, at least for the week. Energy, too, started out really strong. Nice, beautiful price action for 2 days. Kind of into the third day, it started to fall apart. And what we're getting now is big gaps in the overnight hours and then a bunch of nothing. Right. So maybe a topping pattern here. Definitely keep your eye on energy today. If we can get above that highest peak of $74, we could see a new breakout. On the other hand, though, if we happen to break down below yesterday's lowest, that'd be around 71.70. Then we're going to look for this to like give us a rollover signal back down to $70. Right now, the best plays have been energy and finance, energy, finance, energy, finance, energy, finance. Tech has been good just because of how expensive it is. And, with options, selling expensive stuff works good. But it definitely hasn't been, the a trade for me, anything more than just selling options in tech, just because of the cost ratio. Everything else is down on the day: cloud computing, emerging markets, finance. But finance has been the play, right? Goldman Sachs, um, Bank of America, Wells Fargo, run those financial names. And one of the easiest ways to do that is I built these flex grids, and you can go in and pick your sector. So you go to the financial sector, the XLF. These are the names that make up the XLF. So you can see them in their aggregate. Most of the time, they're all going to be giving you the same signal, the same pattern, the same setup. But what you'll find is sometimes one will begin to lead first, and then the others follow, good or bad, right? So you can oftentimes get a heads up. Say you're in Bank of America, and you suddenly start to see a pattern emerge in Bank of America or in Wells Fargo or JP Morgan, giving you a heads up that, hey, you're losing momentum, you're losing trend, right? Or that it's picking up so that you can add in to an existing trade. Keep your eye on finance. And the other one is energy. And when we're talking about finance or energy, or really any of the sectors, you got to remember that there are subsectors, right? So I don't just look at energy, I look at XOP. Those are two different parts of the energy sector. you can go and break these down into like green energy. You could break them down into production, distribution, drilling, solar. Um, the algos were playing around in Halliburton yesterday. Hard to see it when it's in play, but looking back, it's always a lot easier to see it. Keep your eye on that thing. See if they're done today. They may not be. Right? They may not be done. They may want another bite at the apple. We had some really nice wedge plays. They all failed, but they were priming up really nice yesterday, like WMB yesterday. There's a really nice wedge. Didn't work out exactly the way we were anticipating. Rounded reversals on the day for a lot of these. So energy and finance has been the go-to. Metals and mining has been some really nice long plays. All of those are names that you can just go and follow down in the ETF. There it is. So CLF, X Steel, you know, that was a really crazy reversal in AA yesterday, Alcoa Corp. And then CMS, mostly they're getting that pop and then that's it, like CMS. I mean, it gave you that good run at the beginning, and that's really about all you got. But those reversals were the better plays. Same thing in RIG yesterday, RIG. That was just a phenomenal reversal play yesterday. These are way up, way up. So, I've been watching for reversals for a good move to the downside, and we keep not getting it, which is why I end up playing long again. But should we start to break to the downside, it should be a really good run. Just don't see it happening yet. The sectors that we've been looking at are like the legacy old school S&P sectors. But that doesn't cover our world, the what we live in today. We're missing some sectors in there that are important. So what I do, since we need a perspective of these sectors with a pre-market measurement, I've been using TrendSpider for this because it does give you pre-market change percent. Not a lot of places do. Even Thinkorswim doesn't. I had to modify it to get it to show me that. So we're looking at the EV market. That's one of those sectors that aren't necessarily in the S&P. EV market is down considerably. The crypto market also down. And the pot stock also down, right? So when we're kind of flipping through these sectors, these three sectors that I just hit on aren't really well represented in the old school S&P style sectors. That's why we had to do it that way. That's not to say that there isn't good trades, especially if you want to go long. This is weekly options list, just a list of companies that or ETFs that have weekly options. Plenty of names that are moving to the upside, but when we're looking at these names, we want to bring it into a perspective. It's not just one name, it's what does that name represent? What sector, subsector, what industry does it belong to? Because that'll be how we focus our attention and narrow that list of 600 companies down to, two or three companies to trade into the open. If we stay highly correlated, then consider the protocol play that I continue to talk about. Right? If this is the list of the most liquid stuff that was traded in January, and we're going to be updating this list for the February over the weekend. If this is the most liquid names on the list, then what we want to focus on are the top names in this list that represent each of their sectors. And it ends up with a much smaller list. It's the Alpha Protocol. The idea is if we're in a highly correlated state, every single one of these names should follow the S&P. So if the S&P heads to the downside all of these names are going to the downside. If the S&P goes to the upside, then all of these names are going to the upside. So that when we're looking at the advancing issues, if we're in a highly correlated state and the advancing issues are showing that, then we can go long in all of those, or we can go short in all of those. Running something like just buying a 45 delta call in every single name on that list. So this is the advancing issues yesterday in the Nasdaq. This is the advancing issues in the S&P yesterday. You can see that significant move to the downside in both of those markets, and the move to the downside showing correlation. But we wouldn't consider this correlated high enough to run alpha protocol, right? There's only 400 names. We want to see 470, 480, 490 names, right? Or to the downside, we want to see that almost every single name was declining. So we would want this below 100. On the Nasdaq, since there are only 100 names, we'd want to see it below 10 or maybe below 15. To the upside, we'd want to see it above 85, closer to 90, maybe 95. We want to see it in a highly, highly correlated state, because we would blindly be going in and buying a call or buying a put at around the 40, 45 delta in every name on this list. Now, of course, you might notice Google or Amazon. I mean, this is my list. My list is set to my account size. You might want to knock some of those bigger names off if it makes you uncomfortable to consider buying a call in Google or a call in Amazon. But in the alpha protocol, if 95 names out of 100 in the Nasdaq are all running to the upside, then everything on this list is going to be running to the upside. You may get 2 or 3 names that don't, but those losers will be easy to spot. You can kill the trade quickly, so it's not a max loss, and all of the others are going to run. You may as well trade like an algo, because the algos do it, and it works really good for the algos, right? You could go in and individually pick, a name on the list and feel really good that you did your diligence. You went in and you waited for the setup and you sat down and monitored and blah. Yeah. You just go in and buy every single one of these alpha protocol activations. Something to think about, guys. Call it what you want. I call it that. You can call it Bob's uncle. That's it. It's Friday. I will be streaming in the large caps today, even though nobody is scheduled to stream. I'm going to do it anyways. Start around 9:15 or so, and I'll see you guys there.